Good afternoon, everyone. It is November 4th of 2024, new month. I hope that everyone had a really fun Halloween. For those of you who have kids, it's always it always sort of takes you back in time a little bit. It kind of feels like yesterday that I was that age, kind of going around trick or treating. We have two kids ourselves, two beautiful little girls, and a third on the way. So Halloween has become a central part of our lives. So I hope everyone had a fun time, whether it is Halloween or over the weekend. And as it relates to the markets, we have had two down weeks in a row with the markets. Overall, the strategies have held up well, so it's good to see. We did have some volatility in the latter part of last week. Not unsurprising because, sure enough, there's something that's happening here in the next 24 to 48 hours, which is the much vaunted US election, right? And, everyone's been worried about it. Everyone's been concerned, nervous. What's going to happen? Will the country be around the day after the election? And I will say with absolute certainty, and I know that compliance is not a huge fan of using the word certainty, but I will say with certainty that the US will be around. The sun will rise. We will be able to grab a coffee on Wednesday, and the world will continue to spin around. And, really today's focus is going to be around the election day playbook. How do we want to position ahead of that election? I mean, there's only a day to go, but more importantly, do the results matter? And what do we do T+1 after the election? So three big things that we're going to focus on this week in particular is, first of all, we do want to look at some of those important market levels ahead and after the election. Uh, there's many factors that are at play right now. We do have the election. That's what we call event risk. We do have the Federal Reserve that's shifting away from a hawkish policy toward a dovish policy. In other words, moving away from hiking rates and moving toward something more accommodative in terms of cutting rates. And then number three, we have the economy and the business cycle and Christmas. And obviously the biggest time of the year as it relates to consumption in a services-based economy. So we shouldn't forget that and what's going on with the business cycle, because that's the number one driver as it relates to asset prices and risk and the appetite to take risk. So we're going to go through all of that. We're going to compare the current rate environment as it relates to interest rates to 1995. This current market environment in general reminds us a lot of the 1990s, right? Big rally, early 90s, lots of pessimism as it relates to the country, the economy. The car industry was in the dumps. You had a lot of outsourcing of blue collar labor. And then, things started to pick up. And in the mid 90s, you had that inflation scare, Fed hiked rates, killed off inflation, and you had this reacceleration. And of course, the rest is history as it relates to the next 4 or 5 years, right? So lots of comparables there. We're going to go through that. And lastly, is it Trump or is it the economy driving risk on behavior? When we look at the betting odds of Trump versus Harris, and when we look at economic surprise indicators, they're both kind of acting the same way. We believe that is a spurious correlation in itself, but is it the economy or is it the odds of Trump being elected that are leading to what we call more cyclical outperformance versus more defensive outperformance during times of uncertainty? So we'll go through all of that this week. In terms of that election day playbook, we had a big down day on Thursday, kind of out of nowhere, gut punch. And what precipitated that were some negative earnings out of the mega cap tech space. You had some so-called Trump trades that unwound a little bit as if you look at the crypto space, for example, that had a big pullback after a big breakout the last couple of weeks. You had certain industries such as energy bouncing back after being sold in anticipation of Trump winning and in anticipation of more oil production. Well, oh, what if he doesn't win, right? And so let's buy some energy, let's sell technology. So you had some of these mean reversion trades that all came together once you had a couple weak earnings reports on Wednesday evening. So a lot of this seems more like trade versus trend, right? So we do a lot of work of trade versus trend. So when we look at the market here, the S&P 500, trend is positive, right? So when we look at the 200-day, we look at the 50-day moving averages. Again, very strong breadth. Most stocks are participating in the current bull market rally. This pullback that we've seen is right back to 56.95. That is tactical 50-day moving average support from a trade perspective. But that structural support of 5,400 going back to the last decent pullback that we saw back in August, again, is right around 5,400. So we wouldn't be too concerned until we start breaking those levels. But for now, we look at a little bit of unwinding ahead of the election, right? People got a little excited if you were on that side of the political fence, or if you were believing that was going to happen and you want to put bets in the market that you think would benefit from that. That was just unwound a little bit at the end of last week. So this is the key that we look at. So when we look at the S&P 500, when the S&P 500 is in an uptrend, so what we're in right now is a current established uptrend, 52-week highs, positive breadth, number of new highs versus new lows continues to hit cyclical highs. When we have that type of environment during an election day, right? 3 months later, the average of the S&P 500 is up 5.4%. 6 months later, it's up 7% historically. The percent of positive outcomes, 84.6% and 84.6%, both 3 and 6 months out. Where it makes a difference is when the S&P is already in a pre-established downtrend, down 2.6 and down 0.1. I point this out because when I look at that, that tells me that it has nothing to do with the election or who won or which party is in power. What it has to do is that the most important thing is understanding, are you entering an environment where the S&P is in an uptrend or in a downtrend? And that's important regardless if there's an election on Tuesday. If there was no election on Tuesday, I would still want to pay attention to, are we in an uptrend or are we in a downtrend? And we're in a strong uptrend right now with good breadth, cyclical outperforming defensive, and generally speaking, the economy continues to click along nicely and earnings have been good. So I pay more attention to that versus what happens on Tuesday. And we can see it in credit. So when we look at volatility, a huge pickup in the VIX. I mean, we're almost at 25 on the VIX. And there's something interesting is that the S&P 500 is only about 3% off its highs, but the VIX is at almost 25. In most other cycles, when the VIX gets to 25, the S&P 500 may be down already 7, 8, 9, even 10%. So I think it's very interesting that the VIX is so high, but the markets really haven't really batted an eye at all to that. And what's even more interesting is that corporate credit spreads have looked at the current environment and said there's really nothing out there that we're overly concerned about. And I bring that up as I compare the equity market to having an adolescent child and the corporate credit market to the adults in the room, right? You don't get the high frequency trading, you don't get the day traders, all that kind of stuff. That's it's flushed out of the system. In corporate credit land, it's longer term, stickier money. You got well, we sort of, I'm not sure I totally agree with this, but the so-called smarter people are in the credit land. Listen, like that's an argument for another day, but certainly it's longer term money. And so when you see this and the spread's not doing anything, I would say that I'm going to generally lean on believing what's happening in the credit markets versus the volatility market. So we look at the economy or Trump. So has the market action been related to the likelihood that Trump is going to get elected and therefore cyclical stocks do better? This belief that they will do better under him? Or is that to do with the economy? So when we look at the 10-year yield, the 10-year interest rate, it has gone up in line with those economic surprises. Why is that? Well, generally speaking, better economic activity leads to higher long-term rates, right? Because it's a reflationary type of environment. But what's also interesting is you look at the Vegas Trump odds, in terms of will Trump be elected or not? And obviously, the higher, the better that is for candidate Trump. When you look at that, there is close alignment with both the economic surprise index and cyclical stocks versus defensive stocks. Okay. And they've generally fallen. You can see here rising up with Trump, falling down with Trump, and then rising up with Trump. I am agnostic as to who wins. My job here is not to say I'm pro-Trump, anti-Trump, pro-Harris, anti-Harris. My job is to simply look at data and say, is there causation to correlation, right? And the truth is we don't really know. This could very well just be spurious correlation. It could very well be, right, that with those economic surprises ticking up, you obviously get cyclicals that are outperforming defensives. And that is, over time, we've seen that to be the case, that is a material correlation, right? That correlation has meaning, substance to it. It could very well be pure coincidence that the Trump odds have followed that as well. So suffice to say is we don't know what will happen the day after the election, but I'm always going to go back to my North Star, which is this chart here. S&P 500 an uptrend, good breadth, number of new highs outpacing new lows. That's what we want to see, right? So that's our North Star in terms of how we guide through all of this noise. And I will say, for all those naysayers with the economy continues to surprise to the upside, and you see it backed by the action of cyclicals versus defensives. Economically sensitive stocks have been outperforming defensive stocks. That doesn't mean it will continue, but this is a set of good symptoms. And as it relates to rates, right, we talked about this 1994 to 1996 analog, where the anticipation that the Fed's going to cut leads to long-term rates going down. And then what happens is, it's a classic buy the rumor, sell the news, or sell the rumor, buy the news, is that when the Fed actually does it, the market's like, okay, I knew it was going to happen. Maybe we overdid it on rates going down too much. Let's start to sell bonds and send rates higher. Well, look what happened from 1995 compared to 2024. Rates down, 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 down into that first Fed rate cut. And then rates start to go up. Classic buy, rumor, sell news. And then resumption of trend, right? The important thing here is this is trend. This is trade, right? Unless the market continues to play in that action and trend changes, which trend can change. But for now, we are in a trade amidst a broader backdrop of a counter trend, right? So this is what we call a counter trend rally in a downward sloping trending rate environment. So if I'm a betting man, and in some cases I am, right? I would say that overall, the trade is probably long in the tooth. That counter trade is long in the tooth, and we're going to start to see rates head back lower. Another interesting clue as to what's going on with the economy and what's going on in politics is Bitcoin's acting fantastic. Now, we did get a pullback in Bitcoin on Thursday and Friday of last week, but I look at Bitcoin as a hedge against the US dollar. I look as it relates to rates, right? If rates are going down and we're in a soft landing environment, Bitcoin should, in theory, do very well. From a regulatory standpoint, if we're going into a lighter regulatory landscape, Bitcoin should do well. So I won't go into politics and say who's going to be less regulatory and introduce more regulation. I'll let our audience answer that question. But Bitcoin, generally speaking, will do well in an environment where risk taking, risk behavior is what we're in a risk on environment where rates are subdued, right? In other words, we want to be in an environment where paper is not a substitute to a risk asset. And then number three, how is the US dollar performing and how is regulation doing, right? So that is ultimately what helps an asset such as Bitcoin, right? Is it, so our question is Bitcoin trying to give us a clue as to what may happen on Tuesday? Again, we don't know. We don't make election calls. We're not smart enough for that. The other big the other big thing that we or the other big question that we've gotten is that what do we make of this idea that gold and S&P 500 are both up 30% year over year? Is this idea that the market is flying blindly right now and ignoring all the warning signs like, oh my God, gold is up. Something must be up, right? What's gold seeing that the market's not seeing? Is the world about to end and everyone's owning gold to protect against this pending apocalypse? No, that's not where we kind of look at the world a little bit differently. There's been two other times that this has happened. November '09, April 2010. Both times, by the way, fantastic times to be buying risk assets because those other times were QE1 and QE2. In other words, the first regimen of money printing, second regimen of money printing. This webinar, this YouTube is not about debating whether the government should have printed money the first time around or the second time around or the third time or the fourth time or the fifth time, right? That's not what the debate here is. It simply is if they're doing it, what benefits? I'm just a random person sitting here in San Diego, California. I have no impact as to whether or not the government's going to cut rates, print money, not print money, increase rates. I just need to figure out what are they going to do and how's it going to impact asset prices. So QE1, QE2, gold and S&P go up 30% year over year. September, October 2024, the rate cycle begins. The rate cutting cycle begins. So does that mean that markets and negative dollar assets such as gold and Bitcoin are set to do very well? Suffice to say, we will hold our judgment, but we think we lean on the side that these assets are probably well positioned. And then lastly, just looking at the the VIX structure, the volatility structure ahead of the election. We've looked at this chart before, of course, and remember, the risk is already there. People are already pricing in risk during the day of the election. Price is price. So we're going into the election and everyone knows it's happening on Tuesday. This is not like if you're concerned about the election, you decide to short the market on Monday, you're not making a bet. I'm not saying you're not going to be right, but you're not making a bet that people don't know about already. Institutional investors have been preparing portfolios for this for the last 6 months. And some are positive and some are negative. But that demand for protection is pretty high, as you can see. VIX protection jumps right around November 24, and then it falls off, right? And usually portfolio protection, the price or cost of portfolio protection rises the further out you go to the future because you have more uncertainty, more unknowns. I don't know what's going to happen in the next 10 months. I really don't know what's going to happen in the next 24 months. But I kind of have a good idea what's going to happen in the next week, so I don't need that protection. When it spikes or inverts where the price is higher in the next week than it is 8 months from now, that says, oh, wait, something's up, something's going on. Risk is being priced in, right? So again, maybe that fear of the election is already baked into prices. So bottom line, ladies and gentlemen, it's just an election. That's all it is. No more, no less. It's just an election. Markets are jittery. That's okay. Remember, trend remains strong. That's our North Star. Number two, significant amount of money remains on the sidelines. So when people ask me, like, what can power the market? We've had 2 good years. Truth is, year 3 can be choppy. So you want to pick your spots in the market. But the other thing I will say is that there is a significant amount of money on the sidelines. Number 3, confusion of the election and lower rates may be catalyst to bring money off the sidelines and back into risk. So that's what we got for you this week. I know there's a lot of questions, there's a lot of concerns, and that's okay, right? If you don't do this for a living or you're not looking at the markets day to day, it's understandable, right? We're looking at Tuesday with a little bit of uncertainty, but we also know that we got to stay true to our North Star. So if anyone has any questions or concerns, please feel free to reach out to us. 888-543-3776. Your advisor is here. They're ready to help. And if there's any questions that we can ask, we're here to help as well. So have a fantastic week and talk to you on the other side of that election. God bless. Take care.